Welcome back to the deep dive. We're going to take a deep dive into the world of airlines this time, specifically Sun Country Airlines. You've shared their Q4 2024 earnings call transcript with us, and let me tell you, this airline's playing a different game than the big guys.
Yeah, they really are. Sun Country's got this fascinating hybrid model. They do scheduled passenger flights, charter flights, A&D. They've got this rapidly expanding cargo business. They've got three wings keeping them airborne.
So they're not putting all their eggs in one basket. How does this three wings approach actually play out in a turbulent industry? Fuel prices, competition, all that jazz.
That's the genius of it. Let's say there's a dip in leisure travel. Sun Country can ramp up their charter business or lean into cargo operations to balance things out. It makes them much more resilient than airlines that are heavily reliant on just passenger travel.
So they're like the airline version of a Swiss Army knife, always ready with the right tool for the job. Their Q4 earnings call had a lot of buzz, right? 10th consecutive profitable quarter record revenues. Were you surprised?
Honestly, not really. It's a testament to their strategy. Take their capacity management, for example. They're not afraid to adjust their scheduled flights based on demand, which is key in an industry that's constantly in flux.
So it's not just about flying, it's about flying smart. Now their cargo business really caught my eye. It seems like that's their high-growth engine right now.
Absolutely. Their partnership with Amazon is a game changer. They took delivery of their first dedicated cargo plane under this deal and have 8 more on the way by summer 2025. They're projecting this could potentially double their cargo revenue in the next year.
Whoa, double the revenue. I did some back-of-the-napkin math, and that's a lot of extra cash. What could they do with that kind of money? Buy a small island? Okay, maybe not. But seriously, what's their plan?
Well, for one, they're being very strategic about fleet expansion. Instead of splashing out on new aircraft, they're reclaiming planes they previously leased out to other airlines. It's a clever way to grow without a huge capital outlay.
So it's like they had this secret stash of planes just waiting for the right moment. Talk about playing the long game. But what about the passenger side of things? With the post-pandemic travel surge, how are they managing that demand?
They're actually in a sweet spot right now. The strong demand means they can be more selective about routes and pricing. Plus, their capacity adjustments have helped them optimize their revenue per passenger.
Okay, so they're not just filling seats, they're filling them strategically. But it can't all be smooth sailing, right? There must be some challenges they're facing. What are some of the potential headwinds?
Well, fuel prices are always a concern for airlines. And while their cargo business is booming, it's still largely tied to the e-commerce market, which can be volatile.
So it's a balancing act, riding the wave of growth while staying agile enough to adapt to changing conditions. Before we dive into their financials, what stood out to you as particularly interesting in this earnings call?
For me, it's their commitment to operational excellence. They're laser focused on things like on-time performance and minimizing mishandled bags, which is crucial for building passenger loyalty, especially in a competitive market.
Yeah, nobody wants their vacation ruined by a lost suitcase. Okay, so we've got this airline that's doing things differently, playing the long game and making smart moves. Let's get into the nuts and bolts of their Q4 performance. And remember, for you listening, what's your biggest takeaway so far? What's piqued your curiosity about Sun Country's approach? Keep those thoughts in mind as we dive deeper.
All right, let's crack open these numbers. I know financials can sometimes feel like a dry desert, but trust me, there are some juicy insights hidden in Sun Country's Q4 performance.
I agree. And sometimes it helps to think of these numbers as clues, pieces of a puzzle that tell a story about the company's strategy.
Okay, Detective, what's the story these numbers are telling us? What jumped out at you when you looked at their Q4 results? Well, first of all, they're clearly on a growth trajectory. Their total revenue for Q4 was a record-breaking $260.4 million, up over 6% from last year. But what's even more interesting is how they achieve this growth.
So it's not just about growing, it's about growing strategically. Let's break it down. They've got their passenger business, which includes both scheduled and charter flights, and then there's the booming cargo operation. Where did they see the most significant gains?
Their passenger revenue increased by about 2%, reaching $231.8 million. And get this, their average fare also went up by 2%, hitting almost $160 per ticket. This suggests they're not just competing on price, they're offering something that customers are willing to pay a premium for.
So they're not just another budget airline, they're carving out a niche for themselves. What about their charter business? Is that still holding strong?
It is. Charter revenue grew to $48 million, up over 2% from last year. But there's a little twist here that I think highlights Sun Country's savvy. A portion of their charter revenue is tied to fuel costs, and because fuel prices were actually down in Q4, they received less revenue from that fuel reconciliation.
Okay, so that's kind of a technicality, but if we were to factor that out, what would the real growth in their charter business look like?
Hold on to your hats. Excluding that fuel reconciliation, their Q4 charter revenue actually jumped by about 10%. And what's even more impressive is their ad hoc charter revenue. That's where they really capitalize on short-term opportunities that surged by a whopping 27%.
Wow, that's like finding a $20 bill in your old jeans. What's driving that surge in ad hoc charter demand? Are they suddenly flying rock bands around the world?
It's more about being flexible and responsive.
Yeah.
Let's say there's a sudden need to transport a sports team or a group of emergency responders. Sun Country can quickly adjust their operations to meet that demand. The revenue per block hour for charter flights, again, excluding the fuel reconciliation, went up almost 5% compared to last year. They're clearly making the most of every opportunity.
Okay, so their passenger and charter businesses are both performing well. But let's talk about the real star of the show, cargo. You mentioned earlier they're projecting to double their cargo revenue. What did their Q4 numbers look like?
Phenomenal. Their cargo revenue soared by over 13%, reaching an all-time high of $28.6 million for the quarter. And this was despite a slight decrease in the number of cargo flights they operated.
Less flying, more revenue. That sounds like the dream. What's the secret sauce behind this cargo magic?
It's their partnership with Amazon. The new terms of their agreement, along with regular rate adjustments, led to a 16% increase in revenue per block hour for cargo flights.
Yeah.
And remember those 8 new cargo planes they have coming in? They're expecting those to supercharge their cargo business even further in 2025.
Okay, so their revenue is up across the board. But as anyone who's ever run a lemonade stand knows, revenue is only half the story.
Yeah.
What about their costs? Are they managing to keep those in check?
This is where their operational discipline really shines through. Their total operating expenses only increased by about 2.6%, which is pretty much in line with the growth in their overall flight operations. They're not letting costs spiral out of control even as they expand.
So they're being fiscally responsible. But with all this growth, particularly in cargo, are they expecting their costs to increase in the coming year?
They are. They're projecting their expenses, excluding fuel costs, to grow at about the same rate as their overall flight operations, which they expect to increase by 9% to 10% next year.
Okay, so costs are going up, but it sounds like it's a calculated increase driven by strategic growth. But hold on, we talked earlier about them potentially reducing some of their scheduled passenger flights to focus on cargo. How does that play into their cost picture?
Great question. Those 8 new cargo planes are going to be a significant cost driver in 2025. While their overall flight operations are projected to increase, their scheduled service in terms of available seat miles, or ASMs, is actually expected to decrease between 3% and 5% next year. Those reductions will mainly happen in the latter half of 2025.
So they're making a strategic shift, prioritizing cargo growth, even if it means slightly reducing their passenger capacity. But won't that impact their cost efficiency?
It will. They're anticipating what they call CSM. That's cost per available seat mile to increase by a mid to high single-digit percentage in 2025. It's a trade-off they're willing to make in the short term to position themselves for long-term growth in the cargo market.
It's like they're playing 3D chess with their resources, optimizing for the long game. All right, we've talked about revenue, we've talked about costs. What's the overall picture of their financial health? What does their balance sheet look like?
They're in a strong position. They ended the year with over $205 million in liquidity, and that's actually grown to over $226 million as of early February. They're not just sitting on a pile of cash, though. They're using it strategically.
So no shopping sprees, no buying that island.
Not yet. Their capital expenditures last year were about $88 million, which included buying 3 planes they previously leased. And here's the kicker. They don't expect to need any new planes until at least 2027.
So they're all set on the fleet front. Where are they focusing their investments? Spa treatments for the planes, tiny TVs in every seat.
They're actually being quite practical. They're projecting about $70 million to $80 million in capital expenditures this year, with a big chunk of that going towards spare engines. They're clearly focused on keeping their current fleet in tip-top shape.
Makes sense. No point in expanding if your planes aren't in top flying condition. But they've also got those planes they leased out to another airline. What's the latest on those?
Good memory. They've actually extended the leases on 3 of the 4 737-900 ERs, with those planes now set to return in 2025 and 2026. This gives them a steady stream of lease revenue while they ramp up their cargo business. The 4th plane already returned last November and is expected to start flying for Sun Country again by mid-2025.
Smart move. So they're making the most of every asset they have. But what about their debt? Are they saddled with a mountain of loans?
They've been proactively managing their debt. In Q4, they refinanced some of their, kind of like getting a better interest rate on your mortgage. It's going to save them about $800,000 in interest expenses this year. They ended 2024 with what's called a net debt to EBITDA ratio of 2 times.
Yep.
EBITDA is essentially their earnings before interest, taxes, depreciation, and amortization. It's a measure of their profitability.
Okay, so without getting too deep into the financial weeds, it sounds like they're in good shape. They're managing their debt, investing strategically, and have plenty of cash on hand. But everyone wants to know, what's the outlook for the future? What kind of guidance are they giving for the first quarter of 2025?
They're projecting total revenue between $330 million and $340 million for Q1, driven by a 7% to 9% increase in their overall flight operations. They're also forecasting a fuel cost of $2.76 per gallon and are aiming for an operating margin between 17% and 21%.
Okay, so they're projecting solid growth, stable fuel costs, and a healthy profit margin. Sounds like they're firing on all cylinders. We've covered a lot of ground here: revenue streams, costs balance sheet, even some fancy financial ratios. What are the key takeaways you want our listener to walk away with from this deep dive into their financials?
For me, it's their discipline. They're not just chasing growth at any cost. They're making strategic choices, managing their resources carefully, and prioritizing long-term financial stability.
Absolutely. They're not just flying, they're flying smart. Now, beyond the numbers, there's a lot more to unpack about Sun Country's unique approach, their company culture, their labor relations, and how they're navigating a rapidly changing industry. We'll dive into all of that in our final segment, so stay tuned. We're back for the final leg of our deep dive into Sun Country Airlines. We've explored their savvy business model and impressive financials, but there's more to their success than just numbers.
You're absolutely right. Often the unseen elements, like a company's culture and how they treat their employees, can be just as important as their financial performance.
So what's the vibe like at Sun Country? Are they all about high fives and ping pong tables, or is it a more buttoned-up environment?
From what I've gathered, they've cultivated a culture of empowerment and collaboration. They encourage their employees to take ownership and be problem solvers, which is essential in an industry where adaptability is key.
So it's like they've created a high-performing flight crew where everyone's working together towards a common goal. But let's be real, airlines have faced some serious staffing challenges lately. How's Sun Country faring on that front?
It's definitely a tight labor market, but Sun Country's approach to labor relations seems to be giving them an edge. They recently reached agreements with both their flight attendants and dispatchers, which speaks volumes about their commitment to fair treatment and working conditions.
It's a reminder that happy employees often translate to happy customers. But let's talk about some potential turbulence ahead. What are some of the challenges or risks Sun Country might face in the future?
Well, fuel prices are always a wild card for airlines. While they factored in a relatively stable fuel price for Q1, any unexpected spike could eat into their profitability. They're also heavily reliant on the e-commerce market, which can be unpredictable.
So even with their diversified model, they're still exposed to certain market forces. Are there any other bumps on the radar we should be watching out for?
Competition is always fierce in the airline industry. While Sun Country has carved out a niche for themselves, they'll need to stay agile to stay ahead of the curve. Also, as they expand their cargo business, they're becoming more dependent on a few key partners like Amazon. Any shift in those partnerships could impact their cargo revenue.
It sounds like they need to keep their wings flexible and be ready to adjust their course as needed. But overall, what's your big picture assessment of Sun Country? Are they a shooting star, or are they here to stay?
I'd say they're a comet blazing their own trail and charting their own course. Their success hinges on their unique approach, their commitment to operational excellence, and their ability to adapt to a constantly changing landscape.
It's a reminder that in the airline industry, sometimes it's not about being the biggest. It's about being the smartest and most adaptable. Thanks for joining us for this deep dive into Sun Country Airlines. We hope you've gained some valuable insights into this fascinating and unconventional airline.
And for you listening, we'd love to hear your thoughts. What surprised you the most about Sun Country's strategy? What are your predictions for their future? Until next time, keep exploring, keep learning, and keep those wings up.